Do you own exotic investments? Well, what kind of trouble might you run into at tax time? Here to talk with me about that is Jean-Luc Bourdon from Lucent Wealth Planning. Jean-Luc, welcome.
Thanks, Bob. Thanks for having me.
It's a pleasure. So, first off, I think we might want to describe what exotic investments are before we talk about the trouble that they can create.
Yeah, what I define as exotic, sexy investments are the investments that aren't traditional. So typically, investors use stocks, bonds, mutual funds, ETFs, things that are highly regulated, specifically by the SEC. And then there is, of course, an entire universe of investments that are far less regulated. Of course, there are private businesses that aren't subject to any government regulation at the federal level, private real estate, but also private equity, real estate trusts. I see a lot of people being offered options, warrants. And so there are more complex investments subject to less regulation. And so when that happens, they appear a little more exotic because they're more unusual.
And what kind of trouble can people run into at tax time with these investments?
Oh, what a great question. Yes, people very often at tax time discover the consequences in terms of complexity and cost that those investments can trigger. So a typical investment, like your typical broker's account, is going to generate a Form 1099 that investors are very familiar with, and it's relatively straightforward. But many private investments trigger Form K1, and those can be far more complex, and they are costlier to integrate. They can be certainly costlier to integrate into a tax return. So sometimes investors get very small positions in an investment that produces a K1, and the tax preparation cost of integrating that K1 is greater than anything that investment will ever return. And so I've run into very frustrated investors in terms of the complexity involved, the cost involved, and also the time involved. Those Form K1s can be late, and sometimes investors have to file an extension because they're waiting for the K1 to be issued. And so that's an additional wrinkle that they run into.
And I would imagine if they're getting the K1 after they file their tax return and have to file an amended return, there may be some income that they didn't expect that causes them some additional taxes and maybe penalties even.
Yes, that's very possible. I mean, hopefully investors remember that they own those investments and wait for the K1. But if they forget, and it certainly has, I've seen it happen many times, investors just file a tax return, then a Form K1 comes unexpectedly, and yes, it needs to be amended and fixed.
Jean-Luc, typically with a K1, is it ordinary income or capital gains or dividends or interest income? What sort of income are they? Does the taxpayer have to report with such investments or such forms?
All of the above, Bob. All of the above and more. What can be reported on a Form K1 is pretty much limited by the complexity of the tax code. What a Form K1 does, it takes all the income and some expenses from an entity like a business or a trust, an estate sometimes, and passes it on to the individual level. And so whatever happens at the level of the entity passing on the information is to be integrated in the taxpayer's tax return. So in the case of an oil and gas partnership, for example, the K1s can be tremendously complex, can have dozens of pages and involve an enormous amount of complexity. And if an investor doesn't know about it, it'll come as a bad surprise at tax time, because it could be very costly to add a very complex for K1 to a tax return.
It's probably worth noting too, Jean-Luc, that if you receive a K1, but the investment is inside a retirement account, it's not as problematic.
Yes, using a retirement account to hold those complex investments is a great strategy to avoid the complexity. And one of the holdbacks to putting some of those more speculative investments in an IRA, for example, is that the custodian may not hold the investment. So for traditional custodians like Schwab, Fidelity, for example, may not want to hold it in there. And also, if it's more speculative, there's a greater risk of loss. And a loss in an IRA is just not helpful. In a taxable account, of course, will trigger a tax deduction.
So, I mean, all this by way of saying that one shouldn't necessarily avoid investing in an exotic investment, but they need to be aware of sort of the end game when it comes tax time.
Yeah, making informed decisions is just so essential. What I try to avoid is surprises. I could have known, should have known, are very unfortunate, and then avoiding regrets. Sometimes people just get excited about the potential return of those investments, and of course, the potential return is the most elusive aspect of those investments. What is certain is the amount of complexity that they trigger. So. For example, if I was to invest in an investment that produces a Form K1, I would ask to see a Form K1 from a prior year to get an idea of what it entails. And so making that informed decision is so important. Also, with international investments, there's a number of considerations and complexity and different types of taxation that are not favorable for the investors. And none of that should come as a surprise to the investors. So they need to connect with sometimes a team to find out beforehand what the implications are. And I mean a team because there should be a tax expert to guide on the implications on the tax side, but also there could be an attorney involved to guide on the legal implications if the investment is not traditionally regulated. Investors have to hire an attorney to review the partnership agreements and look at the specifics of the investment.
So we've talked about investments that generate K1s, Jean-Luc. Other exotic investments that come to mind are crypto and non-fungible tokens. What do folks need to know about reporting those kinds of items when they're buying and selling and reporting gains and losses with respect to tax time?
Yeah, the main thing to know is to report all the details of it to their tax preparer. Sometimes people assume that out of sight, out of mind, it's not generating a form. They don't have any kind of paperwork to turn in. They don't necessarily think it's relevant. It's very important to report it to tax preparers. Now, the IRS is asking preparers to inquire of their clients whether there is any crypto activity involved, but it's just much better to be proactive and disclose all those transactions and give an expert a chance to sort it out. There's also a lot of complexity there that most investors need guidance with.
And I don't know if you would categorize these as exotic, but folks who might have ISOs and RSUs, do they need to think about trouble ahead at tax time?
Yeah, and I think the considerations come well before tax time. A lot of decisions have to be made about when to exercise and strategies that go around how to best utilize options. And so working also with an advisory team is really important, knowing the tax consequences and also knowing the financial planning implications, knowing the strategies. And there's a fine balancing act between managing the risk, managing the potential of those investments, and also putting enough aside to guarantee that in the worst case scenario, the holder of those options still has enough to walk away with that they can be happy with.
So, Jean-Luc, we've covered a lot of ground. Anything we missed or anything that just bears reemphasizing?
No, I think just that to me, the emphasis is always to go in with eyes wide open and consider not just the risks, the investment risks involved, but consider the costs involved in integrating those investments into a tax return. And then the legal implications, asking what if everything goes right? What are the implications? And what if everything goes wrong? What are the implications? Because if a public company gets itself into trouble, the SEC steps in, regulators step in. When a private investment goes wrong, you're on your own. It's you and your attorney against the company, and knowing what could go wrong and what is involved then, I think is important. I've seen clients spend many years being miserable following a legal drama from an investment that probably they should not have made.
Well, Jean-Luc, it's always a pleasure having you share your knowledge and wisdom with us. It's greatly appreciated. Thank you.
Thanks for inviting me. Thanks, Bob.